The number just dropped, and it is not theoretical anymore. Silver closed at $90.10 on first notice day as 52.63 million ounces of delivery demand stepped forward to test 86.13 million ounces of registered inventory, after 74.38 million ounces had already been delivered in the preceding 60 days. J.P. Morgan, 52.6 million ounces, demanding physical delivery. Right now, today. Not in a future projection, not in a worst-case scenario model, in the actual documented CME published delivery notice data that updated 1 minute ago. And the vault that must satisfy that demand has 86 million ounces in it. 86 million, against 52.6 million being demanded simultaneously, on top of the 74 million that has already left in the last 60 days. Comex has now delivered 86.4% of its current registered inventory in just 60 days, the highest 2-month delivery rate in exchange history. Fortune, the highest. In history. Not in a decade. In the entire recorded history of this exchange. This is AG John OG. This channel has never sold you a single thing and never will. If what you are about to hear matters to you, and it should, subscribe right now. Because the people who understand what First Notice Day just revealed are not waiting for the weekend to think about it. They are acting on it right now. Let's go. The registered inventory available to meet delivery requests currently stands at approximately 86 to 103 million ounces officially. Some analysts estimate that effective unencumbered inventory, metal truly available without creating obligations that exceed custodians' willing commitments, may be significantly lower. Finance magnates. Significantly lower. That distinction matters enormously, and almost nobody in mainstream financial media will explain it to you. The registered number is what the exchange reports. The unencumbered number is what is actually available to hand over to someone who just filed a delivery notice. The difference between those two numbers, the gap between what Comex says it has and what it can actually deliver without creating a chain of competing claims, is the specific vulnerability that 52.6 million ounces of simultaneous delivery demand is now probing in real time. The paper-to-physical ratio is hovering near 360 to 1. For every real ounce in the vault, there are hundreds of paper claims. Inventories have slipped under 100 million ounces for the first time in modern history, with withdrawals running around 785,000 ounces per day. Even during the January 30th crash, when price was smashed from $121 to $64, vaults still lost 3.3 million ounces in a single day. Price down, metal leaving. That is not retail capitulation. That is big money choosing custody over leverage. Fortune. Read that last sentence again. Price went down 36% in a day, and physical silver still left the vault at the same pace. The entities pulling metal are not speculators responding to price signals. They are industrial users, sovereign institutions, and strategic buyers who need the metal for reasons that have nothing to do with whether the paper price is higher or lower today than yesterday. You cannot margin hike a solar panel factory into buying less silver. You cannot crash the paper price and expect a semiconductor manufacturer to cancel its procurement order. The rally coincides with CME data showing 10,526 contracts, 52.63 million ounces, standing for March delivery against 86.13 million ounces of registered inventory. This is occurring immediately after February 2026, delivered 5,036 contracts, 25.18 million ounces, the highest February delivery volume in modern Comex history. J.P. Morgan, the highest February delivery volume in modern history, followed immediately by 52.6 million ounces demanding March delivery on first notice day. This is not a one-month anomaly. It is an accelerating trend. Every month setting a new record above the prior month. Every delivery cycle draining more inventory than the cycle before it. And the vault responding the only way a vault can, by getting smaller. Now let me show you the number that makes 52.6 million ounces genuinely dangerous rather than just impressively large. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery. That meant roughly 26% of Comex's registered inventory disappeared in a single week. A significant portion of what is reported as registered silver is either non-eligible or already encumbered in some way, and thus not truly available for delivery. The pool of actually deliverable, fully eligible silver is much smaller than the headline figures suggest. SBC Gold, 26% of registered inventory in 7 days, in January, historically the quietest delivery month of the year. Now apply that delivery intensity to 52.6 million ounces demanding delivery in March, the primary delivery month, the one where delivery demand is structurally expected to be the heaviest, and it is arriving on top of a vault that has already delivered 86.4% of its registered inventory in the preceding 60 days. Global silver supply has been in persistent deficit for 5 consecutive years, with the 2026 shortfall projected to approach 200 million ounces. Industrial demand, driven by solar panels, electric vehicles, 5G infrastructure, AI hardware, and medical applications, is growing far faster than mine output. China has designated silver a strategic asset and imposed export restrictions, cutting off a major global supply source and accelerating the drawdown of existing inventories. Meanwhile, the United States has added silver to its critical minerals list and launched Project Vault to stockpile critical minerals. You do not take such steps when silver is abundant. Golden Crest Metals. Project Vault. The United States government is stockpiling silver as a strategic critical mineral, not because silver is plentiful, because it is not. And the 52.6 million ounces demanding delivery today from a vault with 86 million ounces is the clearest single confirmation of that scarcity that any public data source has produced. Now let me give you the honest counter-argument, because intellectual honesty is what separates this channel from every silver hype account that exists. When delivery occurs on the Comex, physical silver does not typically move. A delivery is a transfer of a warehouse receipt, essentially a warrant of ownership. The silver stays in the vault unless the new owner decides to withdraw it. That same warrant can change hands multiple times without a single ounce leaving the warehouse. So when you hear that deliveries are surging, it does not mean silver is vanishing from Comex vaults. It means ownership is changing, not location. Discovery alert. That is the most important counter-argument stated with full force. Delivery does not automatically mean the vault empties. Ownership transfer through warehouse receipts is the normal mechanism. The exchange can manage delivery stress through warrant transfers, eligible to registered conversion, and exchange for physical arrangements that move demand from Comex to London without requiring a single bar to move. One of the loudest claims fueling default fears is that February saw a 98% delivery rate. Here is the issue. That 98% figure is based on a denominator error. Open interest is not a static stockpile. Discovery alert. The denominator challenge is real. Open interest represents active contracts at a snapshot in time. Contracts that are continuously being opened, closed, and rolled. The 52.6 million ounce figure is the demand at the moment of first notice day. It will not all hit simultaneously. It will stagger across the delivery window, and the exchange has 48 hours to source eligible metal, convert it, and satisfy the demand before any default condition technically exists. Hold those counter-arguments. They are legitimate, and they are still insufficient to explain away the most important data point in the entire counter-argument, that even during the January 30 crash, when paper silver fell 36%, vault outflows continued at 3.3 million ounces per day. The people demanding physical metal are not responding to paper price signals. They are executing procurement strategies that were decided weeks or months before today's delivery notice was filed. Here is what this means taken together right now on first notice day, February 27, 2026. Silver has surpassed $100 per ounce, driven by a credit crisis in paper silver, China's export controls, de-dollarization, and nuclear energy demand. Comex faces significant delivery pressure in March with open interest far exceeding registered stocks. This could lead to price bands of $100 to $120, $120 to $150, or even $150 to $180. Kitco. Nearly 40 metric tons were pulled overnight, punching SHFE stocks below 10 million ounces and flashing acute physical tightness in the world's key wholesale hub. Silver screaming toward 94 represents the last major resistance level on long-term charts. A clean break risks a disorderly run into 3-digit pricing as shorts lose control. Fortune. Default scenarios could push silver prices to $150 to $300 per ounce as alternative sourcing costs and panic buying create extreme volatility. Physical scarcity fundamentally alters traditional price discovery mechanisms as spot premiums expand and regional markets segment. Industrial users transition from just-in-time procurement to strategic stockpiling, creating sustained demand pressure independent of financial speculation. Bloomberg. 52.6 million ounces, 86 million ounces available, 74 million already delivered in 60 days, the highest 2-month delivery rate in Comex history, the highest February delivery volume in modern history, a 6-year cumulative supply deficit approaching 820 million ounces. China ring-fencing 65% of global refined silver behind 44 approved exporters. Samsung locking up 100% of a mine's output for 2 years. The United States adding silver to its critical minerals list. Volatility is not random noise. It is the market's desperate attempt to ration dwindling physical supply while the paper architecture continues pretending abundance exists. Golden Crest Metals. The paper architecture is pretending. The delivery data just told you the truth. Watch the daily CME Vault report over the next 5 sessions. Watch whether 52.6 million ounces generates actual bar withdrawals or resolves through warrant transfers. Watch whether the eligible to registered conversion pipeline can move fast enough to satisfy demand that has already been filed. And watch silver's price in the first session after markets reopen, because the gap between where the paper price closed and where physical demand is pricing metal in Shanghai tonight will be the opening bid on Monday morning. The CME delivery reports are public on the CME Group website. They update every business day. Every number in this video is verifiable in under 10 minutes from primary sources. The ones who verify will not need anyone to explain what the data means. First notice day just dropped. 52.6 million ounces demanding delivery. 86 million ounces in the vault.